Welcome to Debt Matters. Imagine finding out that the person who sold you your car actually secretly inflated your interest rate, just to pocket a bigger commission.
Yeah, and then the financial regulator actually agrees that you are owed money. I mean, millions of people are in this exact situation right now.
Right. They're looking at this proposed, what, 9.1 billion pound compensation pot.
Exactly. But just as those checks are conceptually being written, the legal system completely freezes the entire process until 2027.
It's crazy. Millions of drivers are just sitting in total limbo.
Yeah, so we really need to unpack what this pause actually means for you, the consumer, if you're wondering where your money is.
Because it's not just the consumers who are confused, right?
Oh, absolutely not. We have to examine the operational reality for the industry, too. I mean, this delay is fundamentally reshaping how creditors, debt buyers, and collection agencies actually handle disputed accounts.
Which makes sense.
Yeah, the way financial institutions interact with disputed consumer credit is just, well, it's changing entirely based on this standstill.
It feels exactly like hitting a massive red light when you're already late to work.
Oh, that's a perfect way to put it.
Right. You're just sitting there at the intersection. Everyone involved is stuck waiting, and the frustration just builds by the minute.
Yeah, and the risk of someone, whether it's a driver or in this case, a consumer or a lender, just making a really bad decision out of sheer impatience goes way up.
Exactly. So to understand why collections agencies have to completely alter their strategies to navigate this standstill, we have to look at the mechanics of the scheme that's currently stuck at that red light.
Which goes back quite a ways, doesn't it?
Oh, yeah. We're talking about motor finance agreements spanning from 2007 all the way to 2024.
Wow, so that's 17 years of historical contracts.
Yep, 17 years. And the central conflict here revolves around these undisclosed commissions.
Right, let's break down how that actually worked in practice, because we're talking about something called the difference in charges model, or discretionary commission arrangements. Yeah, and the mechanics of this are just, they're wild. So a lender would set a minimum base interest rate for a car loan, right? Say 4%.
Okay, 4% base.
But then they would give the car dealership the discretion to charge the customer a higher rate, maybe up to, 8 or 9%.
Which is a huge jump. And the crucial mechanism is the financial incentive tied to that discretion, right?
Precisely. The higher the interest rate the dealer convinced you to accept, the larger the cash kickback the dealer received from the lender.
Wow. So the dealer is sitting across the desk from you, presenting themselves as, helping you secure the best financing.
Yeah, acting like your buddy.
Right. But
Yeah.
they are actually financially incentivized to give you a worse deal.
Exactly. And the customer had absolutely no idea the structure even existed behind the scenes.
I mean, that creates a huge conflict of interest.
Okay.
As a customer, you just assume the dealer is shopping around for the best possible rate.
Or at least offering a standard flat rate based on your credit history,
Yeah, exactly. But instead, the rate is artificially bumped up just to line the broker's pockets.
Which is why the Financial Conduct Authority, the FCA, officially banned this specific model in 2021.
Right. And then they launched that massive review into all the historical cases where this happened.
Right. They proposed an industry-wide framework to compensate consumers who are subjected to these undisclosed commissions. But the whole process has basically ground to a halt.
Because of the legal challenges, right?
Yeah, legal challenges have paused key parts of this regulatory action. The courts are heavily involved now.
And we aren't expecting a definitive hearing until, what, December 2026?
Yeah, December 2026 or potentially even February 2027. And because of this, lenders currently do not have to calculate redress, pay out compensation, or even proactively contact eligible consumers.
Okay, let's unpack this. If the scheme is paused, do lenders get a complete free pass on dealing with unhappy customers until 2027?
Oh no, they absolutely do not get a free pass. The pressure is not off at all.
Really? Even with the court dates pushed out that far?
Yeah, even with that. While the proactive, mandatory, industry-wide scheme is paused, the standard rules of consumer finance still apply in full force.
So what does that mean for an everyday person who thinks they were overcharged?
It means firms are still required to respond to complainants who come forward outside of this specific compensation framework.
Oh, I see. So if a consumer raises a complaint today, alleging unfair treatment or mis-selling on a motor finance agreement, the firm can't just ignore it.
Exactly. They cannot simply point to the 2027 court date as an excuse to do nothing. They retain their strict regulatory obligations to log, acknowledge, and actually handle those individual grievances.
Which really brings us to the very real pressure cooker this creates for consumers.
Oh, completely. Because the broad scheme is on ice, but individual rights to complain are still active.
Right, so people are caught in this very confusing middle ground. They hear about a multi-billion-pound compensation pot in the news.
Yeah, and then they find out they might have to wait years to see a single penny. It really creates desperation.
Especially for households that are currently, struggling or in arrears on their vehicle financing.
Exactly. When households are squeezed and they're just hoping a payout will clear their current debts, they often turn to fee-charging claims management firms.
It's an information vacuum. When official guidance goes quiet or it gets wrapped in all this dense legal jargon, people just panic.
They do, and they end up hiring expensive guides to walk them down a path they could have actually navigated without fees.
Right, if only they had clear directions. I mean, a claims management company might take, what, a 30 or 40% cut of the consumer's compensation?
Yeah, 30 or 40%, and often that's just for filling out a template letter and requesting the original contract.
That is wild.
Which is why clarity is the only defense against that. You, as a consumer, need to understand exactly what parts of the process are suspended and what steps you can take for free.
Okay, so the mandate for lenders to proactively issue checks is paused.
Right. But your right to ask questions about your specific contract is fully active. A consumer can submit a subject access request, or a SAR, to their lender directly.
And what does that do, practically speaking?
Well, it forces the lender to provide all the data they hold on you. That includes the original finance agreement and the specific commission structures that were applied to your sale.
And you do not need to pay a third party a massive percentage of your potential redress just to send that email.
Exactly. You can do it yourself for free.
So what happens when a consumer is actively struggling to pay their car loan right now?
That's a great question, and it's a huge area of misunderstanding right now.
Right, because if they discover their interest rate was artificially inflated by one of these discretionary commissions, does this regulatory pause mean they can just pause their monthly payments until the court decides in 2027?
They absolutely should not stop making payments. I cannot stress that enough.
Well, okay, even if they have an active mis-selling complaint.
Yes, even then. Withholding payments on an active finance agreement will lead to defaults. It will damage your credit file, and it could actually lead to the vehicle being repossessed.
So the obligation to service the debt remains entirely, regardless of the pending legal challenges regarding the historical commission.
Precisely. You still have to pay.
That dynamic must directly impact how collections departments have to operate right now.
Oh, it changes everything. This takes a story about historical car loans and turns it into a masterclass on modern collections governance.
So how does a debt collection agency handle an account that might be tied up in this prolonged review?
Well, when a debt is disputed, the way a collector responds carries massive operational and reputational weight.
Okay, break that down for me.
Sure. So a customer might technically owe, say, £2,000 in arrears on paper, right?
Right.
But if that customer has an active complaint stating they were missold the loan, aggressive collection tactics create a severe regulatory liability for the firm.
Wait, so even if a customer clearly missed a car payment, you're saying the debt collector has to tap the brakes just because a broader regulatory complaint might be pending?
Yes, they have to proceed with extreme caution.
But the customer still physically possesses the car and owes the principal balance.
I know it sounds counterintuitive, but the Financial Conduct Authority requires firms to treat customers fairly, especially those in vulnerable circumstances.
Right. Fairness is the key metric there.
Exactly. If a firm aggressively pursues a balance that is actively under dispute, and that dispute centers on the claim that the balance itself is artificially inflated due to an illegal commission structure, well, the collector is violating fundamental fairness principles.
So debt collection right now sits right at the intersection of regulation, customer fairness, and cash flow.
Spot on. The priority right now isn't speed of recovery, it's timing and meticulous documentation.
It's basically like walking through a minefield.
It really is.
I mean, if a collector takes a single aggressive step to demand payment without checking the map, historical documentation of the commission, the complaint logs, the customer's vulnerability status, they trigger a huge regulatory problem.
Yeah, they create a paper trail of poor communication and potentially unfair treatment that regulators will definitely penalize eventually.
And we also have to look at how this impacts the broader debt market. right? Specifically debt buyers.
Debt buyers are in a really tough spot because they purchase portfolios of defaulted accounts from original lenders.
Right. So how does a debt buyer price a portfolio of motor finance debt right now?
That's the million-dollar question. If 20% of the accounts in that portfolio might eventually be entitled to compensation that offsets the outstanding balance, the value of that debt is highly uncertain.
I can imagine the operational reality involves some pretty complex CRM integrations.
Incredibly complex. Systems need to immediately flag any account that has a pending discretionary commission complaint.
So ensuring that, like, automated text messages or letters demanding payment are completely halted while the dispute is investigated.
Exactly. It all comes down to the evidence trail. And the complexity of who actually owns the historical information is staggering.
Right, because you have the original car dealership acting as the broker.
Yep, you have the primary lender who provided the funds. You potentially have a claims management firm acting on behalf of the consumer.
And then a third-party collection agency trying to manage the arrears. That is a lot of cooks in the kitchen.
It's a logistical nightmare. Flawless records are literally the only way to navigate this.
So lenders and their collection partners must be able to prove exactly what was disclosed to the customer back in, say, 2014.
Yes, they need to know what specific commission band was applied, what the customer signed, and how any previous expressions of dissatisfaction were handled.
And if a firm cannot definitively prove their historical compliance,
Then they are in a highly precarious position when trying to enforce the debt today. And the problem is, the data is often siloed, archived on legacy systems, or simply lost because the original dealership went out of business years ago.
wow. So a collections agent getting on the phone with a customer has to verify the commission structure, see if a formal complaint was logged, check if a third party is involved.
They have to calculate if potential redress might offset the arrears, and then decide on a communication strategy that adheres to current fairness guidelines.
That requires an entirely new level of training for frontline staff.
It absolutely does. The conversations have shifted from simply negotiating a payment plan to navigating really complex regulatory disputes, all while managing customer frustration over a timeline that stretches into 2027.
Okay, bringing this full circle, let's look at the roads ahead for the industry. We are idling at this red light, waiting on the courts. What are the actual scenarios when the light finally changes?
Well, there are two main paths here. If the legal challenges fail, and the courts uphold the FCA's authority to mandate this redress, we will see a massive mobilization.
So compensation payouts would begin flowing in 2027.
Exactly. The industry-wide framework would take full effect. Lenders would be required to proactively contact eligible consumers, and we would see billions of pounds transferred to resolve the historical overcharges.
But what if the lender's judicial reviews are actually successful? What if the courts agree that applying current fairness standards to contracts from, say, 2010 is unlawful?
If the proposed scheme is overturned or heavily restricted by the courts, the landscape fundamentally shifts.
How so?
The burden for redress would likely move away from a proactive industry-wide payout model and revert entirely to individual case-by-case complaints.
Wow, so without the proactive mandate, the consumer would have to do all the heavy lifting.
Right. The onus would be completely on the borrower to realize they were subjected to a discretionary commission, gather their own historical paperwork, formally submit the complaint, and fight their individual case through the Financial Ombudsman Service.
Which takes a lot of time and energy.
It does. And that outcome would drastically reduce the total amount of compensation paid out by the industry simply because of the friction involved in the process.
Right, because many consumers just wouldn't know they had a case, or they would lack the documentation to prove it.
Exactly.
I want to leave you with a final thought to mull over, something that gets to the heart of what is really at stake. While millions of drivers and financial institutions just sit at this intersection.
It's a big question.
It is. If this massive industry-wide scheme falls apart in court and reverts entirely to an individual complaint model, how many affected drivers will simply give up on the complex bureaucratic process, effectively allowing a decade and a half of undisclosed commissions to remain completely unchecked? Will they just turn off the engine and walk away?
The answer to that question will shape consumer finance regulation for years to come.
Thanks for joining us on Debt Matters. We will catch you next time.